Welcome to vTalkInsight, Market Drivers Daily for June 22nd, 2026. Today's cross-asset picture is being pulled in three directions at once. Gulf oil risks are easing, the AI investment cycle is accelerating, and central banks are sounding more hawkish even as equities hold their ground. Let's unpack how those forces intersect across energy, earnings, and rates. Energy markets are transitioning from acute shock toward uneasy normalization. Brent crude is down between 2 and 3%, trading in the high 70s to around $70, as diplomatic progress between the U.S. and Iran helps reopen the Strait of Hormuz and reduce the immediate supply premium. Compared with late last week, when we highlighted only a partial reopening under an interim memorandum, tanker traffic and crude exports have clearly improved, and several headlines now point to an interim agreement explicitly aimed at keeping Hormuz open. On the ground, flows through Hormuz tell the story of relief with residual fragility. Recent reports point to 55 oil tankers and 4 LNG carriers transiting, with daily oil volumes around 8 million barrels, up sharply but still well below the roughly 20 million seen before the conflict. A new Hormuz hotline and relaxed U.S. enforcement of Iranian oil sanctions are enabling more barrels to move, and futures curves now imply prices drifting into the 70s. Yet shipping insurers are still making coverage decisions hour by hour, and some cargoes remain stranded, underscoring how quickly conditions could reverse. Falling crude is feeding directly into the macro narrative. Progress in U.S. Iran talks and increased tanker traffic are easing inflation pressure at the margin and have contributed to lower oil-driven components of inflation, which in turn have offered some support to lower long-end yields. At the sector level, airlines such as EasyJet are seeing fuel costs move from headwind to partial tailwind, even as takeover speculation and prior disruptions kept share price volatility elevated. European consumer sectors remain under pressure, with any meaningful recovery now tied to both sustained Middle East peace and a rebound in Chinese demand. Meanwhile, defense names like Rheinmetall continue to outperform on expectations of higher spending. Gold has started to rebound after a 3-week pullback, and U.S. Treasuries retain their role as the deepest flight to safety asset during geopolitical stress. Against that improvement stand a long list of risks that markets may be underestimating. Equity indices have rallied despite earlier Strait closures, and one assessment suggests investors have not fully priced even today's tentative peace, creating asymmetric downside if talks break down. Negotiations involving Israel, Lebanon, and Hezbollah are described as fragile, with key parties absent from some sessions. Iran is seen as unlikely to surrender its regional proxies, nuclear program, or de facto control over Hormuz, where it is already floating the idea of transit fees and tighter passage rules. Nuclear inspections are back, but limited to routine checks, far from the intrusive regime of prior agreements, while a 60-day negotiation window is viewed with skepticism given how long past deals have taken. Together, these factors keep the door open to renewed supply disruption, oil spikes, and upward pressure on bond yields. Beyond the Gulf, political and strategic tensions in other regions are adding a slower burn layer of risk. In the UK, leadership infighting and the uncertainty around Andy Burnham's fiscal and foreign policy stance are pushing risk premia higher at the margin, even though gilt moves remain dominated by global factors. At the same time, China's new export controls on U.S. rare earth firms, while partly symbolic, highlight ongoing leverage over critical minerals that are essential to both defense and AI supply chains. That reinforces concerns about supply disruption if tensions escalate further. Looking ahead, the key watch points are the durability of U.S. Iran interim arrangements, day-by-day shipping and insurance conditions in Hormuz, concrete UK policy signals, and any escalation in Chinese export controls. Those will set the backdrop for how energy, defense, and cyclical equities trade as attention increasingly shifts toward the AI and rate story. Artificial intelligence remains the dominant structural theme, but the conversation is shifting from hype around a handful of megacaps to the breadth and plumbing of the AI economy. The U.S. is still viewed as the clear leader in AI-driven investment opportunities, anchoring many high-net-worth portfolios to U.S. assets despite geopolitical noise. What is changing is the scope. Capital is now flowing into data centers, energy, semiconductors, cybersecurity, and vertical applications, creating a more complex cross-asset footprint than the early phase of the rally. On the real economy side, adoption is becoming a strategic imperative across multiple industries. Wealth management CEOs are prioritizing AI integration to boost productivity and sharpen client engagement, while 3/4 of small businesses using AI report tangible cost savings and better cash flow management. Fears of a wave of job losses have not yet materialized. Instead, rapid technological change in AI and data infrastructure is generating new roles in energy and construction, and broader labor markets remain resilient. Even as entertainment and retail firms move from resistance to pragmatic AI use for content and targeted marketing. Longer term, several projections now frame AI as a potential engine for a $50 trillion global economy and a lift in U.S. trend growth toward 4% by decade end, though the distribution of those gains across regions and income groups remains highly uncertain. Financial markets are already reflecting this build-out in earnings and spending patterns. Sustained earnings momentum linked to AI-related capital expenditure is a key pillar of a constructive global equity outlook, with upside scenarios anchored in multiple sectors delivering double-digit profit growth. Large-scale AI infrastructure financing is ramping quickly, with recent $35 billion style deals in data centers and compute capacity seen as a template for what hyperscalers and AI firms may replicate. Micron's new partnership with Anthropic and strong demand for memory chips underlying that DRAM and storage have become bottlenecks, while shortages in both power and key components are constraining how fast infrastructure can grow. Real estate and utilities near major data center hubs are feeling the impact through higher local power demand and, in some cases, rising home prices. The funding side of the AI boom is now coming into sharper focus. As capital expenditure grows, S&P 500 firms are expected to rely more on debt or equity issuance rather than surplus cash, adding potential headwinds for credit and existing shareholders. SpaceX planning a $20 billion bond sale and being flagged by rating agencies for the riskiness of its AI initiatives illustrates how even high-profile issuers may lean on markets to finance speculative growth segments. In private markets, some credit funds have already gated withdrawals after $13 billion of redemptions in the first quarter, amid concerns about defaults and AI-driven disruption to business models. At the same time, a wave of large AI-related IPOs over the next 6 to 12 months, rich valuations in AI, semiconductor names, and limited competitive moats from many startups are feeding asset bubble worries. Within listed tech, a divergence is emerging. AI-focused chipmakers and memory names are seeing peak earnings revisions and strong price gains, while several mega-cap platforms, including Alphabet, face questions over AI talent retention, capital intensity, and the sustainability of their margins. Policy, security, and macro narratives are increasingly intertwined with the AI cycle. U.S. government intervention in semiconductors and AI is now framed as necessary for national security, even as policymakers worry about overreach, unintended consequences, and the impact on innovation and U.S.-China relations. China's leverage in critical minerals and the global stockpiling of copper and rare earths underscore how AI demand is reshaping commodity markets and supply chains. Inside firms, the proliferation of shadow AI and cost-driven use of alternative models, including some for Chinese labs, is creating new security and compliance risks. That in turn is driving a surge in demand for endpoint security and identity management to control non-human agents, with security increasingly viewed as a growth enabler for AI deployment rather than a constraint. Macro-wise, equity markets are largely embracing the AI productivity story as disinflationary, while fixed income investors point out that the near-term infrastructure build-out is pushing up demand for power, copper, and critical components, potentially keeping inflation and rates elevated. How central banks reconcile those competing narratives is becoming a key link between the AI theme and the evolving rate cycle.